In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, good morning once again, Market Rebels. And yes, I did say morning. Stu, this is becoming a routine now. We're supposed to be on at 4. It's just a little shy of 9 o'clock, but we have another webinar today, so we had to kind of record this ahead of time. But I think, the futures down a little bit this morning, aren't we?
Yeah, the Dow's down a few bucks here.
That's from Boeing, yeah.
Boeing's taking a hit. They had that terrible plane crash, very tragic.
Yeah.
PPI came out, relatively bland numbers.
Fairly bland.
It's down, a little bit, not much. Mark.
Okay. So we'll have to see how we close here. So it's always an interesting day, but so far it looks pretty good for the opening bell. But today I've got a very cool topic for us, and Stu, this is going to be right up your alley. I know we both talk about it in Q&A a lot, but it seems like every time that you talk about it, we get lots of questions. People go, how is he figuring that out?
Yeah.
Where is he? And I haven't said what the topic is yet. And I think you know what it is, but I think it's going to be very helpful for people who are trying to figure out this little trick, let's call it. It's actually a little formula. But it will help you to understand the quote board, the matrix a lot better. And if I'm going to pay this for a call, what should I expect to see the put trading for? And it doesn't mean you have to nail it to the penny. Nobody ever is. There's a bid-ask spread, but you should have a pretty good ballpark figure of what the put's trading for. If you know the put, you should be able to understand the call.
Right. And the idea behind the whole thing is, everyone, is that it helps you to, this put call parity thing which is what Bill's talking about, is it helps you to price the options.
Correct.
We get that all the time. Is this too high? Is this too low? Well, it's relative to what? And the answer is there's 3 components here. It's a stock, the call, and the put. And, that's what I think we're going to talk about. Right, Bill?
Yep, exactly. We're going to focus more on the interest and dividend part. But if you're going to do that, you got to talk about put call parity. Exactly.
Yeah. Yeah. So it's all part of it. Yep.
All part of it. So let's get started here. And here's our little thought question, our chalk talk question for everyone. How do dividends and interest affect calls and puts? And of course, we're talking about their prices. So we're going to more focus on that, but obviously lots of other components will come out with the put call parity. But I want you to think about that. And as we always tell you, jot down your answer.
And real quick here, people may think like this stuff doesn't apply to them because I'm just a call spreader or a put spreader, or I just buy. It absolutely does. You know, when you have buy rights, maybe you do a covered calls. A lot of people like to do covered calls. You know, dividends, that really enter into the price. You know, you might get a sign, you might wind up paying a dividend that you didn't think you were going to pay or not get that you thought you were going to get. There's interest rate swap plays that can be, you know, you can do on the puts. It all enters into the pricing scheme, and it's very important to understand where these prices are coming from. They're not made up in thin air from you know, those slimy market makers.
And I know we've had conversations about that when we're putting trades together for ICF, the instant cash flow service. And sometimes we'll say, well, for the buy right, this is looking a little lean. And you'll say, yeah, but there's a dividend coming in.
Yeah, we
You'll
just
say,
had
no,
that, right? And
we've had that a couple of times. And so it
yeah,
might help the covered call, and it might not do so well for stock replacement or something like that. But you
that's right.
have to understand where these numbers are coming from. Otherwise, you're always going to be in the dark. So think about that. Again, jot down your answer. Otherwise, it's very easy to go back and say, oh, yeah, I knew that. Commit to an answer. How do you think, what's going to happen to a call if dividends are introduced? Does it raise the price or drop it? What about for puts? And what about for interest? So jot those down. And what we're going to talk about here is put call parity with dividends, and of course, interest and dividends. We're going to focus more on those components because usually when we talk about these two, we do stock plus put minus call and then equals the present value of the exercise price, whereas the present value incorporates the interest rate. So it kind of gets lost in there where these interests, and then a lot of times we just assume dividends are zero. But now we're going to put these in. So to get started, we're going to do a little kind of backtracking here, little building block that I like to get out of the way. Otherwise, we have to hit the brakes and talk about this, and it kind of interrupts the flow. So this is not quite the start. It's a little building block that we need to understand, and that is the time value of money. And basically what this says is that a dollar today is worth more than a dollar tomorrow. Now, sometimes people say, well, wait a minute, that's not true because of, you know, for whatever reason. We're saying, no, the reason well, that would actually still make it worth far more today. But it's the thing that we're looking at here is that if you have money in your hands today, you could invest it and have more tomorrow. So if somebody says, I'm willing to give you $100 today, or I'll give you $100 a year from now, should make sense to take it today because you could, even if it's 5% interest, you could end up with more. It's the more valuable decision, and it's because you can invest it. Whenever we talk about this, even though we could use different interest rates, it's generally assumed to be the risk-free interest rate because that's something I know for a fact could be part of my decision. So in that example, yes, I know for a fact I can get, let's call it roughly 5% on my money. I might say, yeah, but the market's expected to return 20%. I can get 20%. Well, you don't know that. I could turn on a dime. You could be down 10 or 15% or more.
20 or
25. Or 20 or 25, right. So we're always talking about the risk-free rate. So what the time value of money says, let's say that you have $100, and in finance, we would call this the present value. It's the value now or at the present. But I know I can look at this in the future, and I can say if I invest it at, let's say, 5%, I know I can have 105 a year from now.
Mhm.
And we would call that the future value. It's the value of money in the future. Now, again, we could use different rates. Maybe we're looking at different maturities for bonds. Maybe we want to say, well, I'm hoping to get X amount in the stock market. For different reasons, we might come up with different future values. But basically, we're always looking at the risk-free rate. Now, like any math problem, if we can go left to right, guess what? We can undo it and we can go right to left. So let's change the problem here. Let's say that I owe you $105 in 1 year. And the question is, well, how much should you take today to settle the debt? And some people say, well, my gosh, if you owe me 105, you owe me 105 today. That's not true. That's not understanding finance. Because notice how we multiplied going left to right, we would divide coming right to left. So if I know that the risk-free rate is 5%, we would take that future value divided by 1.05 and guess where we land? Right back where we started.
Shocker.
Shocker, right? So in the world of finance, and I know it looks odd, we would say $100 today equals 105 in the future because we're looking at time or money has different values at different times. So if we value them at different times, we would say those are equal. And so that's a really important concept in finance. But remember, it's whenever we're talking about the risk-free rate that we're generally using this. Okay, now that we've gotten that building block out of the way, let's get into the actual presentation. And before we do, please remember marketrebellion.com/get started. We have a tremendous amount of articles, videos, everything to help you get started with options and to make better decisions. So let's start with our basic put call parity equation.
Bill, should we mention briefly like where that risk-free rate is coming from, like where the markets get it from?
Generally, that's a good point. Generally, it would be a T-bill with the same maturity. So in that example, if it were a 1-year time frame that we were looking at, we would look at a 1-year T-bill,
right,
and say that would be at least a good approximation.
So think about this for a second, everyone. Right, think about the bond yields as you go out in time. They vary, right? Sometimes they're inverted, sometimes they're not. What the markets do is the markets capture. Like Bill said, they capture the T-bill rate for that duration. Sometimes it's an implied rate, or if it's longer, a bond, and we use that rate for that specific expiration date. So your 30-day rate, risk-free rate, absolutely could be different than a 2-year rate.
For sure. Yep.
Right.
And in fact, many of the pricing models will do that. They'll drop that in for you, and that's where they're finding that.
Yeah, that's part of it. It's kind of what they do. You don't have to do it, but it's part of the mechanism behind the model.
Exactly. So you've heard us say many times before that calls are puts are calls. If I know one, or if anything you can do with a call, I can do with a put. It just depends on how we delta hedge it. And the reason that we say that is that there is, of course, a mathematical formula behind it. We've seen this before, but for those who may have not, it's the stock price. This is the price of the stock plus the price of the put minus the price of the call equals the present value of the exercise price. Now you see why we had to talk about present value. So to shorten this up, I'm just going to use the first letters. We talk about S plus P minus C equals present value of the exercise price. Now, another quick note, if there's no sign to the left, it's assumed to be positive, right? We don't have to write plus S, we could, but that means long stock plus a long put plus a short call. So if you're long stock, long a put, and short a call with the same strikes, it will equal the present value of the exercise price. Kind of curious. Now, how could that be, Stu? We always hear about how risky options are. How could it create something that's going to behave like a bond? Well, here's how.
You can absolutely create it to be a T-bill, but why would you want to?
Yeah. I always tell people that for anyone who thinks that options are risky, this wouldn't be possible. It's a better proof that options hedge risk. And in this case, we're just shutting it off.
It's interesting. I just heard myself say, why would you do that? So actually, there's a really good answer for that. The really good answer is you may have a position on that you're looking to hedge like 100%.
Yep.
You're looking to take out all the Greeks and you just kind of want it to flatline. And maybe the liquidity on the position that you have is not quite there at your price. Maybe the other side of the street, the put side, if it's a call, maybe the put side, along with the stock, may be price advantage for you. You got to be able to look at that, or else, it's possible you might be making donations to the market.
Oh yeah, you might have a far more efficient way of closing it.
Yeah.
Right. So anyway, let's say that we have stock trading for 100, and we're going to short the 100 call, and we're going to buy the 100 put. All right, so long stock, long put, short call. So notice what happens if there's only one of 3 positions the stock can be in at expiration. It can either be exactly 100, it can be above 100, or it can be below 100. So let's say that the stock is exactly $100 in 1 year. Well, the options go out worthless. And so how much are you going to close your position for? 100. All right, now let's say that the stock goes up. What's going to happen?
I would actually pay a little more to unwind that because I wouldn't want the pin risk, but we'll get to that.
Yeah, we're not going to get there.
Okay.
So if the stock goes up, what happens? We've got a short call. We're going to get assigned, right? So the put goes out worthless. We lose our shares. How much do we receive from the assignment?
100.
100. Exactly what we got when the stock was exactly unchanged. What happens if the stock goes down? That's the third thing that could possibly happen. Now the call goes out worthless.
Mm-hmm.
What happens now? Now we see in the first case we got assigned. Now we can pull the trigger. We say, all right, I'm going to exercise my put. How much do we receive?
$100.
$100. So look at that. No matter what happens, up, down, or sideways, we are going to receive $100 in 1 year. Well, that sounds a little bit like a bond, doesn't it? I'm guaranteed. I'm going to buy a T-bill, 1 year T-bill. I'm guaranteed to get the face value. So given that, if I know I'm going to get 100, how do I find out today's value? Now you might say, hey, it's worth 100. Nope, that's not accounting for the time value of money. That's 100 in 1 year. What's it worth today? Well, we have to bring it back to the present. From the future to the present. How did we do that? We divided. So if the risk-free rate is again 5%, we know that that position would be worth 95.24. So you could put these three pieces on, not counting commissions, in the market for 95.24. And when you unwind it, what are you going to capture? 100, which means effectively, now it's not an interest payment like it is from actually from a zero coupon. There's actually no interest payments. We wouldn't call it interest, but it's an effective interest. Is 476. And how big is 476 on a 95.24 base? Shocker there, it is exactly 5%. So it all works out. So the keys to understand at this point is that the calls and puts can exactly negate that risk.
So the 470, people may be asking like, well, where's the, if I'm not going to get paid in a coupon, where's the 476 come from? It's going to come from the prices in the put and the call, everyone.
That's right.
Right. The call is going to be a price and the put's going to be a price, and the difference is going to be 476.
And that's what's going to bump that price, that $100 stock, down to a price of 95.24. Now you might say, well, wait a minute, what if volatility is off the rails? That's fine. The call will be more expensive, the put will be more expensive, but their difference will be 476. So remember, you're selling the call, you're collecting more money than what you're spending. You're getting this credit here, this effective net credit. And that's what's knocking this price down to 95.24.
And by the way, everyone, this is called a conversion.
This is a conversion. I think you've probably done one or two in your day, right, on the floor?
It's kind of how I learned how to price these options,
right?
Of
course. You live by this.
Making a market is, well, somebody comes in to buy the call. Should I sell it? Well, I can look at the vol, but I'm also looking at the vol relative to the put.
To the put, of course.
And that's what this is. It's the same thing. Should I sell the call? Well, I know where I can buy the stock because, I got
that's no brainer. Right.
And I got to look at the put. So if I can buy the put at a relative cheaper price than where I'm going to sell the call, I'm going to do that all day long because that's a lock on the money.
And as Stu said earlier, it's a really important point that professional traders always look at relative prices. So, in this example, now I didn't list the actual call and put prices, but if they came out to 476 difference, is one cheaper than the other? Can't, they're kind of priced fairly. But if it came out to where the call allowed me to get $5 of interest, what do we know? We still don't know which is expensive and cheap. We know that the call is relatively expensive compared to the put.
Right.
Yeah, see, so that's how you have to look at things, and that's why these formulas are so important to understand.
Yeah, so the marketplace would be actually, a seller of the call.
Oh yeah,
and a buyer of the put to push that thing,
back into the balance. Lock that in. There you go.
Right. and now you have a real market going on, an auction market, which you have all the time, every second of every day.
That's right. So now let's take the next step. We got to take this slow. So we're now going to include the interest. So I said stock plus put minus call equals the present value of the exercise. Well, we could rearrange this, do a little algebra, pull the call out, and it's going to equal stock plus put minus the present value of the exercise price. So if you think about it, the interest rate is somehow in this equation because we had to divide, in my example, by 1.05. So it's in there. This is just a more compact version. So notice in the previous example, we came up to the present value of the exercise price was 95.24. Well, let's expand the formula if we want to include interest and dividends. So what we're going to do here is say stock plus put minus the exercise price, and then add the interest. See, all I'm doing is I'm separating these. Now, it might be hard to see, but what was the exercise price here?
100.
It was 100. What was the interest? Do you remember what that was?
476.
476. So notice if I say, well, Stu, let's expand this formula and subtract 100, but add back 476, what are you doing? You're making it 95.24. You're just expanding the formula. We're doing it so we can now see the interest. All right, so that's with the interest. Now let's take the next step and do what? Dividends. We know that our call equals stock plus put minus the exercise price plus the interest. And now we're going to subtract out dividends. Now, sometimes people will have a hard time. Why are we subtracting it out? Well, remember when a dividend is paid, it reduces the stock's price. So sometimes I think this can be helpful to look at it this way as think of the call as the stock less the dividends. Again, it's the same formula. I'm just saying it might help you conceptually to visualize, make it easier. It's stock minus dividends and then plus put minus exercise price plus interest. Okay, same formula, but if it helps you to see it. So that's what we're going to do. And now we've just expanded our really concise put call parity formula. So now we can see dividends and interest. All right, so now how is that going to help us? Well, before we go and look at some examples, please remember marketrebellion.com/get started, all kinds of cool stuff just like this to help you get started with options. So Stu, here's actually a very cool pricing model. I know we've been looking for some in Q&A lately, and I found this one that actually shows calls and puts. The one I was using before only had calls, and if you flipped it to puts, it blew everything out. So if it looks a little different to everybody, that's why this is a fairly new one. But let's look at the formula here. Stock plus put minus the exercise plus interest minus dividends. So here I've got the stock at 100, exercise at 100. It's the at the money. Does not have to be. We'll look at an example later. I'm going to use 365 days to expiration just for starters. Interest rates 5%. We're going to do no dividends and 20% volatility. Now, it turns out it doesn't really matter what volatility I use because that's just going to make this number higher. And then the formula has to balance. So let's go ahead and put this to work, to the test here. What should the call be right here, Stu? Well, it should be the stock, which is what? 100, plus the put, 557, subtract off the exercise price, add back the interest, which we know is what? Present value of that number. Now you might think, wait a minute, how come you used 476 before? Well, I kind of hedged a little bit here. I didn't want to get too deep into the math, but for all the math people in finance, we can actually discount by E, which is continuous compounding. And if we do that, the present value is actually 488, not 476. And most pricing models, for mathematical reasons, are going to use E. And that just means we're paying interest at every nanosecond just continuously, instead of saying it's 5% at the end of the year. It's a small technicality, but it does make a little bit of a difference. Okay, so that's why the price, I had to change that there. And then minus 0 for dividends. And what do you suppose that equals right there? Well, if we run through the math, is 1045. So let's put it to the test, Stu. This number right here, what's behind door number 1, should be how much?
1045.
Look at that.
So look, here's another way to look at it, everyone. If you're going to own the stock, you got to pay interest on it, right?
That's right.
I mean, that's whether you pay it or you don't pay it, it's a sunk cost.
Or don't receive it, right?
You don't receive. It's the same thing, right? So that means you have to get money. Look at the options. Look at the call and the put. You have to get paid to pay for the interest that you're going to have to use or not get when you own the stock.
That's right.
Right, and there it is, right there. Right, what's that? 5 and 488. Right. I mean that's how it works.
That's exactly
right?
how it works.
So if that call starts trading for relative to the put at 557, if that call starts trading at 1065, it's too high.
Too high.
How do I know it's too high? Because there it is.
There
right?
it is.
It'll show up in the implied volatility, but there it is.
Yeah.
Right. Suppose the put is trading at somebody comes in to whack 1,000 at 5.25. Take them. Right. You got to buy them because you can buy the stock and you can sell the call and you could lock in that money. It just becomes a T-bill rate.
Yeah. So now you know what's happening in Q&A when we have these questions and Stu says, well, hang on, let me do a calculation. You hear him banging away on some keys. He's doing a rough calculation of the interest rate or the
that's all I'm doing.
Because that's the piece that we need to find out. And also he's doing rough estimates. That's why he'll say, well, it should be somewhere around, and he might say somewhere around 1040, 1050, somewhere. It's just because he's doing very quick calculations, but he knows it's in this area.
All stemming from that, what we call cost of carry.
Just from that cost of carry, right? Now, another thing you can say, we could look at it this way. If the call and the put are the same thing, I could say the call also has to include volatility. So where's the volatility component coming from the put? We know it's got to trade for at least 557, and it is. So that's another way to understand where that's giving us the volatility component, but the call also has to have an interest component. Because when you buy a call, here's the magic link. What are you really doing? You are borrowing the exercise price. So think about it. If Stu goes out and buys the stock for a year, he debits his money market for $100 and misses out on interest, what he was just talking about. What do I do? If I buy the call for this much, I'm not spending 100. I'm spending 1045. I get to leave the balance to collect interest.
Yep.
So in effect, I'm mathematically borrowing money. And that's, again, one of the powers of options, because we're not really borrowing it. I'm not being charged, at least in the sense, interest from my broker. Okay, so that's the way it all fits together. All right, let's try another one here. Let's do, there's our formula. And let's do, what did we change this time? Oh, we're going to do the put. Oh, wait, I'm sorry, we did the put. We're going to do volatility. We're just going to do another example. So remember I said it doesn't matter what volatility you pick. It just changes the puts price. It's the same math. So yes, 60% vol is going to jack up that puts price. All right, so what's going to happen now? Stock is 100, put is 20, let's call it 65. Interest is 488. We have to add that back in. And dividends are 0. I'm sorry, minus the exercise price plus the interest, minus no dividends. So what does that make our call, Stu? Well, it should be 25.53. What does the pricing model say it is? Look at that. Now, you might say, it's not exactly 25.53. There's some rounding going on in here. All right. Plus, also depends. Some models will use 360 days. Some use 365. But they're just rounding errors. If we
and different models may grab an interest rate that's 5 basis points off,
and that's exactly right. That could be something else too, right? But you can see, are you at least in the hunt after commissions and bid-ask spreads? Do you really care if it's 253 versus 2.523?
Bill, can you go back one slide? Okay, so this is for our friend Dr. Mike Ash. So we may have options, we may have stocks that we like to trade, and we're looking for stock replacement options in lieu of the stock. However, the spreads may be fairly wide. Think about that scenario, right? Okay, the spread's 4 points wide, 3 points wide, spread's 20 to 24. How do I know what price to pay?
Right.
We've all come across that situation.
All the time.
Now, if that is the case, that means the call is way in the money.
Yep.
Which means that the put is way out of the money.
Way out of the money.
And if the put is way out of the money, it's probably pretty close to pennies, or maybe it's $1. It's not going to be 1.5, right? It's not going to be 20 cents, $5.20. It's going to be 20 cents, 50 cents, 20 cents, 40 cents. It's going to be 1 to a quarter. You're going to be able to capture a price from the put side to then plug into this equation to come up with a fair value on the call side.
On the call side, right? Because it's not there on the call side, right?
Now you know what to pay.
Now you know.
Now you're not at the mercy of, well, the market's 20 to 25. What am I going to do? Right? You know exactly to the penny. Once you figure out, once you can grab a mark to market on a fairly tight market on the put, look, at 20 cents, 40 cents, you know that they come at 40. You know that because they're offered, right? That's a guaranteed part of the market. Not many of them, but that's one of them. And 20 cents a bid that you don't really care about. So where they come, right? Worst case, you plug in that 40 cents on the put side of it. Maybe you go 30 mark to market. Look, it's not going to really matter that much. But you can then, plug it into this kind of thing, and you can figure out what the fair value of that call is. So now you know what to pay at that stock price, of course, right? That's how you can figure that out.
Yep. Very good. All right. So let's go to, we saw that was our answer. So pretty easy once you start getting the hang of it. Now, let's flip it. All right. So this time we're going to look at the call and figure out the put. So we're going to use basically the same numbers. I did 180 days. All right. And we're going to do 5% interest. We're going to do no dividends, and we're going to do volatility of 30. So now we see on our broker's platform call trading for 956. Well, with a little bit of algebra, we can flip this around and solve it for puts. And that's going to be call minus stock plus exercise price minus interest plus dividends. So what does that come up to be? 956, that's our call price, minus the 100 stock, plus the 100 strike, minus the 488 interest. We have no dividends. And what does that come up to? Knock that out in your calculator, comes up to 712. So, Stu, what should our put be, would you expect?
470-ish.
Right here, 712. Okay, so there's
956. Wait.
Right here, 712.
956, 5%, 30.
No, I'm sorry. I was just, never mind. We've got it for here, 712. It was just what our answer is down here. So that would be our put. Okay, it's just the sum of all of these right here. All right, and that is exactly what the put's trading for. All right, let's try another one. I'm going to keep the time at 180, but now we're going to put a dividend of 1. Now, you have to be careful with the calculators. I believe this one will let you, no, it doesn't let you change it. Some will let you put in the hard number of dollars. It pays $1. Or some want it in percents. So in this case, it would be $1. It's just 1% of that. But you have to be careful of how you're entering it. So anyway, there's our formula.
One's yield and one's a dollar amount. Just keep that
exactly, yeah. A lot of times they'll use yields for things like indexes because they're assumed to be paid continuously. In the S&P, you've got dividends coming in all the time. It's not one date. So it just depends. Usually not going to make a huge difference, by the way, for what we're trying to do. Okay, so we have call equals stock plus put minus the exercise plus interest minus dividend. We have a 105 stock price this time. So I forgot to mention that. I said earlier, it doesn't matter what stock price you use. It does not have to be at the money. So now for the conversion, it does. But in this case, I made it 105. So our stock price is 105. Our put is how much? 546. Our exercise is 100. Interest is how much? Now here we're going to be off probably a little bit because I use 365. 180 isn't exactly half, but I think most people would say close enough. So I'm just going to take 488 divided by 2, This is also why when Stu in our classes will say it's going to be roughly, because he'll do stuff like this and say it's it's a half of this, and you're not doing exact answers. And that's really good enough for what you're trying to do. So I just did 488 divided by 2. And then let's subtract off, if it's a 1% yield, which is what? $1 for a year, how much would it be for half a year?
25 cents a quarter.
Be 50 cents. So if we go through and we add up all of these, it comes up to 1240. So what should our call be here?
There you go.
1240. And there we go. Now, again, we're off a little bit, mostly because of I hedged on the interest here a little bit. But you can see, again, after bid-ask spreads, commissions, are you in the ballpark?
Don't get lost in the noise, everyone.
Don't get lost in the noise. It's 1240. Now, the final point, if you understand that we are adding interest and subtracting dividends, is it possible that these could offset? Yeah, of course. And that's why some models or people just say, what's the net effect? What's the net interest? So in this case, I went back to a year. I made it a 5% interest and a 5% dividend yield, and they offset each other. Okay. So anyway, those are just some things that we think should are really important for people. And I know, Stu, we get so many people in almost every Q&A because we're always talking options and looking at the matrix, and this comes up. And we're a lot of times looking at stock replacement very deep in the money. And Stu will always say, well, hold on, let me check it against the puts. And this
is the only way to do it. There's no other way to do it.
That's why he's right. Now you might say, gosh, he's so fast. Well, yes, he did it for almost 30 years every single day. So don't beat yourself up over it. You can see it's not a hard formula. Just practice with it. And that's what we wanted to do, is to at least show you the formula. Yes, it might be a little daunting right now, but if you work with it, it will become second nature. And it'll start to make sense. Like I said, look at stock minus dividends. Stu mentioned you have to get that interest back. You'll start to understand the formula.
And also, everyone, bear in mind, we're talking about 100 shares here.
Right.
There's going to be liquidity for 100 shares,
right.
and which may not be liquidity for 5,000 shares. Right?
That's right.
SPY it absolutely is, or some
Yeah.
Microsoft kind of stock. But you could have like blah 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 stock that's not very liquid, and if you're trying to do 50 contracts and got to buy or sell 5,000 shares, it may not be there. So the prices may really change, but it's still relative. It's relative to one another. It's just this holds true, but the stock price may change. So
yeah, and that's another really good point, because if you understand markets, and we've talked about the marginal pairs before, what we're really saying is that this holds given this put price, given this current balancing point, because you can't buy all the shares or contracts that you want or sell them at any given price. It's an auction. So that adds another wrinkle to it, like Stu said, so that as you get more advanced, you might say, all right, I should be able to get this price, but you're trying to knock out an order for 5,000 contracts, or like we see in UOA for 50,000 contracts and stuff.
Yeah.
No, it's probably not going to hold.
No.
And that's why you'll see multiple fills, right? Different prints as they walk right up the ladder. So this is where the art side comes into. There's a science side, but there's also an art side. So hopefully we helped you to understand a little bit more about the science side. If you want to join us for Q&A, we can teach you more about the art side as well. So let's go back and finish off with our chalk talk. How do dividends and interest affect calls and puts? What did you write down? There's your answers. Okay. So we hope that gives, again, some good insights. I know we get a lot of questions. That's really worthy of a breakout session, which is kind of what this was here. So we know it helped all of our Q&A people. For everybody else out there on Twitter and YouTube, please join us at Market Rebellion. You can join us every Tuesday, Thursday for discussions just like this. Stu, any final comments?
The put side of thing is really interesting in light of the fact that what happened with interest rates over the last few years.
Yep.
When we had that big giant interest rate pop, what was it, 500 basis points, 400 basis points?
Oh, yeah.
I mean, think about the idea that like if you were using the put side of the equation to maybe hedge some of your portfolio,
Mm-hmm.
and interest rates start rising, all of a sudden those puts become less valuable.
Yep.
Not because the market went up. I mean that too, but taking the delta part of it out of it, the put value
Right.
at that current stock price becomes less with a higher interest rate.
Because of the interest rate.
And that can really, that can have, with a big, with that's
I think we lost you there.
RO. We call that RO, by the way, RHO, effective change in interest rate. So, when you're at the extreme levels of interest rates, that's just something you have to think about, right?
That's right.
How is the change in interest rate, if there is one coming, going to affect my portfolio on an outlook of, well, the interest rate goes up, the interest rate goes down. What's it going to do to my calls or my puts or both? Or if they have a div that they put in there, or they cut the div and they put it back, like how's it going to affect what I have? Moving forward, instead of waiting for the market to tell you, which you may be on the short end of the stick, have an idea of what the outcome. These are part of the hidden risks that we talk about all the time. Find the holes, find the risk. Our good buddy, we talk about him quite often, Steve Levitt, know your risk. This is part of it.
It's absolutely part of it.
Know where the risk is.
Yep. So if you understand, again, we always try to teach people the professional side. These are some of the things that we're looking at. It's always about looking at the relative prices. And if you talk to 99% of other traders out there, it's always, hey, Stu, what do you think Microsoft's going to do tomorrow? Oh, well, you think it's going up? Let me buy a call.
Mm.
And you are so far off base. You're going to make this a million times more complicated. We have to say, what price are you paying for that? And which one is relatively high, which is relatively low. And this is one of the most important tools that you can use for that. So again, we hope that helped, and this is some of the things we like to bring to you on Coach's Corner. And so hopefully, Stu, we get a nice little rally in the markets maybe later. We'll have to see. But
Yeah.
for all the rest of you, we'll see you at noon in our Q&A. And for everybody else, we'll see you next Thursday at 4 p.m. on Coach's Corner, and we'll see you then.